All right. We are live today. Got a great show for you guys. I am rolling solo today. Mr. Breedwell is out on vacation, so we'll be a little light on stock market updates and what's going on, but we've got some housing market shifts happening at the moment. S&P 500 is bracing for impacts. We might be seeing a little bit of a pullback there. Trump has proposed a new tax cut that could really make a positive impact in the housing market. If you're an investor or if you're really just anybody that owns real estate, this is definitely something that will hit your pocketbook, and we'll go over the pros and cons of that. I have been seeing a lot more data coming out about living in a silent recession. We've heard that term thrown around for quite some time, but not a ton of data to really dive into. I don't know if you guys feel it. It seems like things are great. I was talking with my pops this morning. It seems like things are great in many areas, especially obviously the stock market, and not so great in a lot of areas in the economy, in real estate. A lot of people in businesses are starting to see some pullbacks with consumer spending. We saw some reports that were dropped this week. We'll check out some of that data. And, I think a lot of people, as they are, building wealth, I know one of the things for me is we all want to give our kids a better life than we had. And we want to continue to pass along the blessings and to create more opportunity for them and to make things easier. And yet sometimes I kind of struggle with, my wife and I were talking about wanting to give them everything without giving them everything, and still building the right qualities and skills and set them up for success, especially because raising kids in this world is not like raising kids back in the day. So little thread and segment on raising wealthy kids, and that's obviously going to go beyond just the bank account. How do you create wealth and health in all areas of their life? Curious on some thoughts that you guys might have in that. I'll share some of my top investing laws over my 16 years of investing in real estate. One of the most common questions that I get asked is, what are some of the staples that you live by in your business? And unfortunately, many of those laws have come from pain and learning the hard way. And yet, as I have written this list, and I'll share kind of my top 7 if you want the full list, which I'll pull up here on the screen today for you guys to check out. You can just text the word list to 844-447-1555, and I'll send you the full list of those 20 real estate investing laws. Many of these were passed on to me by other really successful investors who have experienced pain, had great success, and used many of those failures as kind of stepping stones to bulletproof themselves and their wealth as they have built in, whether it's investing in the stock market, investing, in my case, real estate. And I believe that these are core staples that anybody invested in real estate at any stage of your journey can utilize to be successful going forward. And we'll also talk about, being that I'm in money raising mode, and I know many of you are always raising money for your deals, for your business, for certain opportunities. I have learned some non-negotiables over the years that I think are really, really important, that I've seen some of the best capital raisers use, and where I see a lot of the breakdowns and failures. Many successful real estate investors or real estate investors and people that fail, the people who entrust them with their money, don't do these things. So we'll talk about those 5 non-negotiables. First and foremost, I got you guys live on the screen here. So today I want to, kind of increase a little bit of engagement, ask some questions. I'd be curious on your guys' thoughts. Let me know where you're tuning in from and what platform you're on here, because we are obviously streaming to a handful of different platforms at the moment. So why don't we start by jumping into Trump's new tax proposal. This is something that I believe is going to be, in my opinion, very beneficial for anybody who owns real estate. And you know how they always do these things. They like to tie in kind of the juicy, sexy, attention-grabbing topics and policy at strategic times. And of course, we are in a midterm election year, which right now it looks like the Democrats per poly market are leading to retake the House and the Senate. Whether or not that ends up being the case, we shall see. But of course, any administration that is in the driver's seat is always going to try and do things that, one, make that administration look good, and two, align with, supporting their, their side of the aisle and the constituents that are voting in that direction. This, in my opinion, is a policy that I think is really bipartisan. I think it's something that benefits the entire industry. If you've been in real estate like I have, this has been one of the most challenging markets that I've seen since I got into real estate in 2010. Obviously, post-financial crisis and coming out of that entire debacle and really rebuilding the industry as a whole out of that depression was, long. It was challenging. But at the same time, it was very opportunistic. And the people who really leaned in during that time are the ones who ended up being the most successful over the years to follow. And for me, the way that this policy reads is, pretty simple. And what this policy reads as is, this proposal would essentially index capital gains to inflation. And what that does, right, is it adjusts your original purchase price upward for cumulative inflation over the time that you held the property. So that way you're only taxed on a real gain rather than a gain that the dollar manufactured. And what we obviously know is inflation, when you're in hard assets, works in your favor, and a lot of times it's a great thing. But at the same time, when you go to get taxed, the IRS doesn't go, we won't penalize you for inflation. We're going to, of course, allow all the benefits of inflation and how it ties into what we do and the money that we take out of your pocket. But when you decide to go sell a property, of course, we're going to tax you on that entire gain. And essentially what this does is it removes that. And I'll break down kind of what that looks like here in a second. Now, the second piece of this policy would raise the home sale exemption to roughly $2 million, which is up from today's $250,000 if you're a single person, or $500,000 if you're married. And that would be a pretty big jump. That would open up a very wide range of opportunity for people to sell and have a nice little tax break on the gains that they would see in their home. So this would obviously apply not just to real estate investors, but this would apply to primary residences rather than just investment property. And so here's some of the pros that I see with this particular policy. And of course, as a real estate investor, I am hoping that this does get passed. And at the same time, I'm not holding my breath because obviously these are big legislation that require a lot of approvals, a lot of reworking. And it's always funny, they love to, promote these kind of tax breaks and tax cuts. And I forget what the percentage was that I saw that actually end up going through. It's pretty small. So if this were to get passed, here's a list of some of the pros that I mapped out. Number one is sellers are going to get to keep meaningfully a lot more money in their pocket on assets that they've been holding long term. And the longer the hold and the higher inflation and the gains that you see and benefit from over time, the bigger the effective cut is going to be, and therefore it allows you to save and keep more of that money for yourself if and when you decide to sell. And what this does as a result of that, in my opinion, is there's a lot of people sitting on a lot of equity in their homes. And yet the last thing they want to do is see a lot of that growth get eroded by paying taxes back to Uncle Sam under a lot of the current tax laws that are there. And so what this does is it kind of breaks free from that, right? It's kind of the lock-in effect kind of gets unshackled a little bit, and it allows people to actually think about selling their properties without necessarily allowing the weight of the tax ramifications to be maybe the number one deciding factor. And so a lot of owners who have, decided to sit in their properties because of those things, and refuse to sell purely because of tax reasons, now finally have a door that might open up for them that alleviates some of that tax pressure on the sale of their property. Number two is this is going to unlock some inventory. And we know that right now we are in a 3 to 5 million home shortage in the United States. Of course, a lot of that is locked up because we've got, I think 4 and 5 mortgages right now are sub 5%. We've got people sitting on, a couple $1 trillion in equity right now, and that ends up being, one of their best bargaining chips, and therefore it's usually going to be one of the last things that they decide to tap into unless they are in, a challenging situation. And if we incentivize people by not feeing them to death or taxing them to death on their largest asset sitting on their balance sheet, that is going to open up some inventory that will come into the market and give active buyers something real to underwrite and to look at and to go after. This also is something that is more applicable to real estate investors, and yet one thing that I think is, I've experienced it myself firsthand, is it really kills forced 1031 buyers. When a lot of people decide to sell a property, specifically an investment property, and you don't want to pay taxes, which if you're like me, I'm going, I've worked hard, I've taken risks, I've operated this property. The last thing I want to do is, stroke a fat check back to the government. So you really have a couple different options. The number one and most popular and well-known one in real estate is 1031s. And that gives you the ability to defer those taxes, to take all of your equity without stroking a check to Uncle Sam and roll it into another property. And when people go through the 1031 exchange, there's some pretty specific laws and regulations around the 1031 process that you have to meet in a pretty short window of time, that if you don't meet that, you either, one, are going to have a failed exchange and you're going to have to pay that tax, or what ends up happening to a lot of people, and I see this and talk to so many investors over the years who have ultimately bought a property that they really weren't that crazy on. It wasn't their first choice. Sometimes it wasn't their second choice, but it was on their list, and they end up buying a property or end up having to overpay for a property just because they don't want to pay on the taxes. And when all is said and done and you actually look at the numbers, they probably would have been better off just paying the tax instead of buying a property and becoming a forced buyer, which is what happens to a lot of these investors. And so if that ends up being passed and this door now opens for investors to, get the benefits from it, they aren't going to be forced to buy a property under the 1031 guidelines in a very short window of time, which is a really big deal, because that then also will open up the window for a lot of investors to look at and analyze whether it makes sense to trade out of a property and not necessarily have to worry about the tax ramifications that you do today, and especially if you don't get that 1031 successfully across the finish line. We also are going to see a lot of capital velocity increase as a result of a law like this getting passed. Money likes to exit tired assets. And once they've kind of run their course, maybe they've done their full depreciation on them, maybe you've got a lot of equity built up in that property and there's really not a ton of cash flow coming out of it. That's something that ended up deciding why I sold some of my hotels, was I had built up all this equity, but the amount of energy and the stress and the risk that went into operating those assets, when I looked at how much cash flow was left over, I'm like, man, I got, a couple $1,000,000 in equity in these properties, but the cash flow is really low. So my return on that equity, the amount of cash that it was spitting out versus the amount of equity that was stuck in there, if I were to roll that equity into something else, I could get a much higher cash on cash return. And there's a lot of properties like that owners have had for a long time that have a lot of equity in it, but really low cash flow. And what this would do would unlock that and allow that cash flow, that equity to flow back into the market, which obviously has a lot of ripple effects and benefits. And this is something that I think we could see some major benefits to the real estate industry as a whole. Because when you think about how many transactions aren't happening right now, you know, if you work in the real estate industry, if you're a lender, if you are an appraiser, if you're a cost seg company, a 1031 company, you're a title company, you know, there are so many insurance provider, vendors, and service providers that all operate within the industry. It's not just the buying and transacting of real estate that benefit, you know, realtors and homeowners and investors, or not, depending on how slow it is, like it's been the last few years. But there's a lot of other vendors and companies that would benefit from the velocity of transactions and, you know, houses and properties being bought and sold if this law were to actually go into effect. So overall, I think this is something that could be a major benefit. Now, of course, there's the other side of the coin. Some of the things that I've, you know, kind of taken note of and seen people talk about is depreciation capture, recapture is untouched. So your basis is your purchase price minus every year that you have depreciated it. And so obviously if you're taking a lot of depreciation and you decide to sell, there could be some recapture ramifications on that you'll have to think about. And here's the other thing. There's no legislation that has been filed here. This has just been televised and talked about. And many people on the other side of the aisle are saying that this is only going to benefit the wealthy. But in my opinion, this is bipartisan from the sole reason that we have a lot of homeowners in this country. And therefore, this is not just going to benefit investors. This is going to benefit anybody who owns a home. And therefore, I think if we were to incentivize a policy that not only benefits investors, but more importantly, benefits the bulk of people who own one of the most valuable assets to their name, which for most people is their home, secondary to their investment or retirement portfolio. This is something that could be very positive, not only for the real estate industry as a whole, but also for the economy as a whole. Because people may want to sell and they may not want to buy another property. They may want to take that money and invest it elsewhere, invest it in a business, invest it back into the economy. And these are all things that I think are a net positive. So I'm curious, what do you guys think? Is this something that you think, one, should get passed? Is this a more of a net positive? Is this a net negative? I'm curious. You let me know your thoughts in the comments as I kind of pull up this next section here. But overall, I think this could be something that, one, I would love to selfishly see, and two, I just think would benefit more people than it hurts. All right, so next we're going to roll over to the silent recession. This is something that I've seen getting floated around for some time. A lot of people are saying, hey, we're in a silent recession. The economy is not as great as the stock market might have many people feeling. And you've obviously heard Ryan say this for a long time, is the stock market is not the economy. And Bridger Pennington is somebody that is a guy that I follow on X. He does a lot of great breakdowns on the stock market and kind of economic assets, policy, things along those lines. And he kind of brought this up that I thought was interesting, being that so many people have been talking about this for some time, and not many people are necessarily given a lot of data to back it up. So let's give a listen to hear what he says. And I want to know your guys' thoughts on this. I got a couple questions for you guys. And I've got some thoughts on this as well.
A silent recession. The stock market just hit record highs, but we're also seeing a 28% increase in Chapter 11 filings, bankruptcies over last year. And if you take out the hyperscalers, we're not growing that much. Now, this is all an op-ed article I just posted on LinkedIn and X. Also, the chief economist at Trellis agrees with what I'm saying. which is most of the growth in our economy is really coming from just a handful of names. Everybody else is suffering. They call it the S&P 493. And the hyperscalers, the Mag 7, are just getting bigger. Right now, NVIDIA at 7.7 of the index is the largest in history. Jason Furman put this best. He said 4% of GDP is responsible for 92% of GDP growth. I would love to hear in the comments down below.
So, obviously he kind of talked... the elephant in the room is, the stock market is great. And if you're invested in many of those big companies, obviously a big one being AI, those ones are absolutely crushing it right now. And I love opening up my stock portfolio and seeing how those continue to grow. And yet there are many laggers behind that. I know that there are a lot of people right now that, if they're not invested in the stock market and have an exposure to those types of things, they are really feeling a pinch. We have a lot of people that are not seeing their wage growth keep up with, the inflation that they're feeling in some of the categories, specifically, food prices, which we'll talk about that here in a second. But I saw today from an article on ABC, Americans are deeply negative on the economy, with nearly 8 in 10 Americans rating the economy poorly. And this just comes after one of Trump's press conferences here today, stating that the economy is doing unbelievably well from the standpoint of Wall Street. I thought that was a really interesting choice of words there. It's doing really well from the standpoint of Wall Street. But when you start to kind of peel back the layers of the onion on the economy, I was talking with the guy that I consult with in his HVAC business, and they've scaled, from 1 to 3 to 5 mil over the last few years. And he was saying that they have been feeling and seeing a pullback in pricing. Been talking with other friends that own businesses, and they've been saying they've seen a little bit of a slowdown. Is that seasonality? We did see retail sales have a little bit of a pullback this last week. And, a lot of people are kind of stating how they are feeling on it, with 71% saying Trump hasn't gone far enough and trying to reduce the price of everyday goods, up from 58% a year ago. I know that when I go to the grocery store, I don't know what you guys feel. Where do you feel the biggest increases in your daily life? I'm just curious, because I know for me personally, wanting to eat somewhat healthy and have healthy meals for my kids, we feel it the most at the grocery store or when we go out to eat. My nickname Fatty Matty is not there by accident. Your boy likes to eat. I like to cook good food, and I like to go eat good food. And Marie and I went out to dinner the other night. I think I had a little appetizer, like cup of soup. We both got a glass of champagne, which, wasn't insanely expensive. And we got 2 courses for dinner, and the bill was $180. I mean, that's crazy, and I'm grateful to be in a position where I can afford that. But I know that, the average family who's grinding on 20, 30, 40 bucks an hour with more than 1 kid or 2 kids, that's a big nut to be able to go out. It's almost become a luxury. And yet I still see restaurants busy and packed. But when I go to my grocery store, I was at the Nugget the other day, and this wasn't some massive haul, but I think we, walked out of there, and I go to the grocery store twice a week, and I saw anywhere from $250 to $300 on the people in front of me. And, I didn't have a bunch of stuff in my cart, and mine was $275, and I go there twice a week. I mean, I track all my expenses. There's an app called Tiller, which is kind of cool for expense tracking and budgeting and things like that. And, I spend anywhere from $3,500 to $4,000 a month on groceries. Mind you, we eat a lot at home, and we eat somewhat healthy food and all of that. But, food prices in the U.S. have shot up by 33% over the last 7 years, which is the biggest jump in grocery prices in half a century. So I'm just curious, what's the one price increase that you've noticed the most in your daily life? And, for those that are on the live stream right now, are you bullish or bearish on the economy? Do you think that we are in a silent recession, or is this just all noise from talking heads and the news outlets, and we're actually doing just fine, and the golden era is here and better days are ahead? What do you guys think? Bullish or bearish on the economy? Drop that in the chat. Let me know what you guys' thoughts are, because I do think that we are in very interesting times. I think two things can be true at once. A wise friend always says that to me, and I think that we could potentially be in a silent recession and still experiencing a very opportunistic, bullish, amazing stock market because of what's going on with AI right now, what's going on with the Mag 7, and many of these companies. So you guys let me know your thoughts, because this is something that I think a lot of Americans are dealing with, and we're starting to see this in the chat, or we're starting to see this in people's everyday lives showing up pretty consistently. So somebody just mentioned the real estate investing laws, and let me see if I can pull these up here on the screen for you guys, because over the years I have had many failures, many good little face plants. And obviously, you guys know, anytime you go out and decide that you're going to go climb a new mountain, whether it's in your business, whether it's a fitness goal, whether it's, money, it's, buying a house, there's always going to be learning curves when you decide to step into a new arena and do something new. And I am a big believer that, you have to be dumb enough to believe in yourself and smart enough to know that if you execute on a plan and you have a healthy level of optimism, you're going to find a way to figure it out. Now, of course, there's going to be some blunders, and most importantly, you want to make sure that you minimize the big mistakes. And that's why having, good coaches, good friends, good mentors, being in mastermind groups, all the shit that is important to be involved in. You don't need to be the smartest person. I've always never been the fastest, never been the smartest, never been the strongest. But I'm confident in my ability to surround myself with the right people and to be humble enough to know that I don't know it all and to let those people guide me, and be hardworking enough to make up for the shortfalls that I do know I have. And obviously, awareness is a very big key part of this. And many of these investing laws have been investing laws that I have either learned from my own failures or have been investing laws that I have learned from, other people that have shared these losses and, these lessons with me. So let me pull these up. If you want this list, I can send this PDF over to you guys. Just comment the word list. You can text it to 844-447-1555. You can drop it in here as well, and I'll see if we can pull it out of the comments. But text it over to that, and that'll automatically send it over to you. So you guys can see this here on the screen. Whoa. All right. There we go. Let me get out of that. All right. So these are ones that, I was thinking about sharing something with my kids one day, because obviously, I'm going to continue investing in real estate for the rest of my life. I always say, as long as I can sign a contract, or, now you can click a button, I'm going to continue to build wealth in real estate. And I do know and believe that it's, one of the most impactful and important asset classes out there. It's tied to a very core need for human beings, which is shelter, or in many cases, businesses that provide valuable services to our way of life and to the economy. And so it's not going anywhere. The real estate industry is definitely changing. Technology, consumer trends, social trends, a lot of these things are changing. And yet many of these laws I know will remain true. And a big part of this is around, mindset. A big part of this is around execution. A big part of this is around risk mitigation. So I'm going to run you guys through these laws real fast, and I'm going to go through it, relatively quickly, but I will give you the full list if you want that. So obviously we all know real estate is one of the best wealth building vehicles on planet Earth. So here's number one. Number one is, of course, we always know and hear people talk about mailbox money. I'd be lying to you if I said real estate was passive. It can be passive if you invest with somebody as a limited partner, like a syndication, or in my case, I've got actual joint venture partners where people bring capital to my deal. We partner and, we're 50-50 or we're 60-40 or whatever it may be, whatever the structure is. But if you have an operator that is like me, who does it full-time, 365, eats, sleeps, breathes it, you can make it true mailbox money for you. And that is one of the most powerful things that real estate has to offer. Number two is a mindset thing. This is something that I've always said to my kids, and I want other people to understand, as we all want things quickly in life. I'm a millennial. I stand and pace in front of the microwave because I want that shit fast. But I think we can all agree that the microwave never produces the same quality of dish that the crock pot does. And real estate is the same way. It is a get-rich-slow industry. Now, if you do it long enough, consistently enough, it can get real sexy. It can put out a real nice, juicy result. And you just have to be patient enough and have enough stamina and staying power in real estate to be able to get that crockpot outcome. Number three is cash flow buys freedom and equity buys options. The ego in me is like, how much can this grow my net worth and my balance sheet? But at the end of the day, you can't eat your equity. You cannot, click a button oftentimes in real estate and realize that equity right away. But the cash flow is ultimately what unlocks the freedom. And it's kind of the flywheel for building a life of freedom in real estate. Cash flow will give you the ability to pay for your bills, have money left over, to keep reinvesting it, to go and travel and do all the fun things that you want, to golf in the middle of the week and not have to consistently grind your ass off. And that's why I love real estate, is because it produces that consistent cash flow. But you need to make sure that your assets are spitting off enough cash flow to be able to then grow your equity because of the cash flow that is tied to those assets. And guess what? As you get more equity on your balance sheet and you become more bankable, what does that unlock for you? It unlocks more options for you to then go and leverage that equity and that net worth growth to go and buy more of what? To go buy more freaking cash flow. And so that's something that I always tell people is, in the beginning, don't worry about how much equity you're going to get out of this property. Focus on getting enough cash flow to sustain your lifestyle, to sustain your investors, because that's ultimately the return that then over time will grow your equity, and then you can take the equity to go and scale your cash flow into buying more assets. Number four is, it's not what you make, it's what you keep. And it's not what you keep, it's how you invest what you keep. And some of the best investors I know, not only do they focus on cash flow and cash planning, but equally as important to them, and I think the wealthier I see people get, they care less about the cash flow, because obviously they've got plenty of it, and they care more about the tax flow and how they can leverage real estate assets, specifically commercial real estate, to go out and utilize tax planning strategies like a cost seg or like a 1031. You got deferred sales trusts or Delaware statutory trusts, a lot of creative tax strategies that are created by the U.S. government to incentivize investors to put money into assets that can give you a nice offset, especially if you're a high income earner. A lot of my investors and people that invest with me, they want the cash flow, but they're already kind of making great money. They would love to get more monthly cash flow and income. That's great. It's passive. They can fund and enjoy their lifestyle. But a lot of the times they're like, how much can I invest and what can I offset so I can keep more money? Because that is generally a return that is not baked into the ROI that many people calculate. They look at cash on cash, right? They look at their IRRs, but there's not really a metric for the KPI of tax savings and how that factors into the amount of money that you get to keep in your pocket. If you can buy an asset that saves you $50K on taxes and you can go and put that $50K to work somewhere else and it can make you another 10%, and you just increased a another $5,000 a year off of that tax savings, and you kept another $50K in liquidity. Really important. It's not what you make, it's what you keep. So another great one that I think is a law that some of the best investors have learned over the years. Number 5, this is probably something that you already know, and yet some of the best and most successful investors I know still fucking mess up on this all the time. They mess up on this all the time, and 22 to today is a perfect example of people still not getting this through their damn hard noggins, which is don't over leverage. You know, debt is such a great tool, and when you use it the right way, good debt can be one of the best ways for building wealth and building it fast, right? Instead of having to use all of your own money, that it sucks up all your liquidity, you can leverage debt to go and buy bigger assets, which can have bigger returns and bigger equity growth, and that's all great. But I've seen investors, specifically over the last few years, we've all heard of those ugly horror stories and syndications that have bought assets, they didn't pay attention to the debt structures, or they got too much leverage on the assets that they bought. And when interest rates started going up and they were over leveraged and value started to plateau, or in some markets actually go backwards, now these people were either stuck, they couldn't refinance their assets, the returns that they were hoping for were way off, they were calling their investors to bring more equity to the table to pay down some of the debt because they were struggling. And so something that is so important in real estate is great to leverage debt on, but you have to know how to not only make it in a good market, more importantly, you have to know how to protect yourself and make it through a bad market. And so just making sure that you don't over leverage. I've seen too many investors see their portfolio, decades worth of hard work, literally get cut in half. Many people go bankrupt. The last thing you want to do, it's better to have little incremental growth than to see yourself, and take 1 or 2 steps up the ladder, than see yourself trying to get up 10 steps up the ladder and you end up sliding down all the way to the bottom. All right. The next 6 to 7, is this helpful for you guys? I'm curious. Just drop in the chat. Let me know if these are valuable. Again, I'm seeing some people comment lists, so I'll make sure to send that out to anybody that wants it. If you text the word list, 844-447-1555, we'll get this over to you guys. Okay, so of course, everybody knows location, location, location. I think now more than ever, we're seeing the real estate landscape change, and this is something that I believe location is going to become even more and more important for building a moat around your asset. Obviously, we know this is one of the oldest rules in the book, and demand for location will always be a great insulator to your value, to the demand if you decide to ever sell it, for tenants wanting to come into your properties. I've had assets in A-plus locations. I've got an asset right now that is D, C location. And while I've got some good traction and opportunity, that also creates some challenges and limits some of my options in the process. So that's something obviously you need to go into your investments eyes wide open on. Learn to crunch the numbers. I always used to tell myself, I'm the relationship guy. I like to shake hands and kiss babies and get belly to belly with people. I'm an extrovert. I leave the spreadsheets for the smart dudes. What I can tell you is, if you're going to invest in real estate, if you're going to invest in anything, the last thing you should be delegating out to other people is to trust that the skill that is one of the most important to build wealth in, when it comes to real estate investing, when it comes to the stock market, or just managing your wealth and your finances in general, nobody is going to care more about your money. Nobody is going to care more about your deal. Nobody is going to care more about your investors. Nobody is going to care more about your returns than you are. And therefore, one of the most critical skills that you have to master is understanding how to engineer a deal, engineer a spreadsheet, understand the returns. Some of the most important metrics that are tied to whatever asset class you're investing in, lean in, learn them, engage. Don't be afraid to shy away from these things because you think that it's too challenging, or in my case, right, I'm the people person. I don't need to learn a spreadsheet. I don't even know how to fucking move around Excel. Well, guess what? It was something that honestly took me years and a lot of reps. I mean, the 10,000 rep rule of getting into a spreadsheet and being fucking frustrated and hitting my keyboard. And yet at the end of the day, now I can whiz around a spreadsheet. I can whiz around a pro forma. I can understand numbers and speak the language of numbers. And the wealthiest people I know, they can all speak the language of money. And you got to understand how to crunch the numbers on your deal. Number 8 is buy value others miss. I think this is probably, in my opinion, one of the things that has been one of my greatest skill sets is the value that people often miss is disguised as hard work. We've heard that quote before. And value add real estate is one of the best ways to force appreciation into assets. But you got to fucking pull your bootstraps up and be ready to get your sleeves rolled up and your hands dirty because it's hard work. Real estate is not easy. No matter what anybody tells you, it's fucking stressful. It's hard. It's challenging. But there is some insanely amazing value that can be captured out of it if you're willing to work hard. And that's why I say when I look around at some of the wealthiest, richest people I know, they're not the sharpest tools in the shed, but they are fucking grinders. They're willing to get their hands dirty. They're willing to check their ego at the door. And so this is where you can really get some great value, is identifying the areas that others miss. And whether that's finding ways to add new income, it's finding ways to reduce expenses. These are things that obviously anybody can master in real estate investing. Take risks you can control, skip the ones you can't. Obviously, there's a lot of different strategies in real estate. Some and many in most scenarios are going to be out of your control. Interest rates, it's out of your control. But guess what? You can buy a rate cap on your interest rate. You can buy rate insurance. There are things that you can do, right? I'm, giving you examples here, but thinking of the things that you can control, and as long as there's more weight in those than the things that you can't, and the things that you can't, you've been very conservative, and you've built in safety nets, and you've built in stress test scenarios. Those are things that, again, if you can take risks that you can control, you're going to be overall successful as a real estate investor. Number 10, this is one of the best ones. This is just such a fucking good statement. I love this one. If you were like me in the beginning, I just thought every deal that came across my plate, I got to do the deal. Like, I just got to find a way to do it. And a wise mentor said, deals are like buses, Matt. There's always another one coming right around the corner. And that's so true. I've ended up passing on certain deals that, I wanted to do them so bad. And in hindsight, thank God I didn't. Some of the best deals are the deals that you don't end up doing. So if it's not clear and aligned with your criteria, your goals, your team, the things that you need to have those boxes checked in your real estate investment criteria, be willing to walk away from the deal. And sometimes walking away from the deal has actually led me to getting the numbers or the structure that I really did want to get. So don't be afraid to walk away. Deals are like buses, and there's always another one coming. All right. Are these valuable for you guys? Let me know in the chat. I would love to. Let me see if I can throw these up on the stage, or maybe I got Tone. Somebody else is helping out with that. So number 11, the team is so important. I have dealt with every type of vendor, professional, over the last 16 years that you can think of, some of the best in the country and some of the worst, and everything in between. You will pay for the best, and yet the early me, the cheap me, I wanted the best deal. I wanted the lowest price, my cheapest contractors, my cheapest vendors, the most inexperienced brokers, but the best price, on their fees. I paid for it in one way or another. Either I paid for it positively and I got exactly what I wanted and it set me up for success, and it cost me a pretty penny for it, but it was worth it. And on the other side, I've experienced the complete opposite and received a lot of pain, a lot of stress, and a lot of extra work cleaning up messes. So just make sure that you're aligning with the best people. And that reputation, collateral, and capital that you're going to build in the process, guess who those people hang out with? They've got standards up fucking here. They will not associate with slackers and losers and fraudsters and people who lack integrity. Those are the people that you want to be in business with. Don't kill a good deal. This is one that, especially I think is the biggest challenge for a lot of newer investors, is we just want to squeeze a little bit of extra negotiating, juice out of the deal. I want a little bit better of a price. I want a little bit better of a structure. But at the end of the day, it's not going to be a win-win deal if somebody is losing. And I've dealt with a lot of people over the years that they want to win and they end up losing the deal. They end up losing a relationship. They end up hurting their reputation in the process because they just got too greedy. So don't over-negotiate a deal. Don't risk losing the deal. One of the sayings that I love to live by is it's better to own 100% of something instead of 100% of nothing. Or if it's, you're got to bring in a partner and maybe you're cutting yourself down a little bit, but you really wanted to try and do this deal by yourself. It's better to own 100%, a slice of a watermelon than 100% of a raisin. So don't get greedy. Don't kill a good deal by getting over-negotiated in the process. Number 13, get it in writing. This is one that, unfortunately, I have experienced the pain of. And you want to know who I've experienced it with the most? It's people that you've had a relationship with, that have been a friend or somebody that you trust. And unfortunately, I've been in some deals and some partnerships with people that we had agreements and arrangements, and whether they forgot or it got omitted or, it didn't get solidified in writing, that's led to some painful conversations, some parting of friendships, and I just know that this is something that can save so many people. It feels weird, like, hey, we trust each other, right? Yes, we do trust each other, and we trust each other enough to get this agreement in writing. That's really what it comes down to. I want to see people have success long-term in this business and have great relationships, and the people that I end up seeing experience the most pain, get stuck in lawsuits. That saying of, there's only one winner in a lawsuit, and it ain't the plaintiff and it ain't the defendant. It's the attorney. The amount of emotional, physical stress and money that goes into, working through and mediating disagreements, it fucking sucks. For me, it's not worth it. And the best way you can avoid that is get it in writing. 14, the only good escrow is a closed escrow. I got a quick story on this one. So I don't know if my friend Rach is watching this live stream or not, but Rachel and I were, new realtors full of piss and vinegar. We've got our first $1 million buyer, and obviously this was before I even, bought my first investment property. I was still living at home. I had no money to my name. I was putting most everything on a credit card. We got our first $1 million buyer, and there were some things that were off about this buyer, but, I'm willing to look over those things. Like, he wouldn't give us a formal proof of funds, and he was changing stories, but everything was still checking out. And again, he didn't just fool me. He didn't fool Rachel. He didn't fool title and escrow. He didn't fool the sellers. He fooled all of us. And this was a closing that was going to happen 2 weeks before Christmas. So I was like, this deal's fucking closing. I'm going to go out and I'm going to put all my Christmas presents, $1 million commission at 3%. You can do the math. That was more money than I'd ever seen at, 21 years old. And I was fucking pumped. And he removed all of his contingencies, and the deal looked like it was closing. So long story short, closing period happens. He's supposed to wire his remaining funds. It didn't happen. He goes silent. The next day goes by. We finally get a hold of him. Oh, yeah, sorry, something came up. I'm going to go and get the funds wired. Doesn't happen again. Long story short, the dude ends up being a fraud, and the whole deal fell apart. I had all this Christmas gifts and presents on, my new credit card that I'm trying to build credit on. And it was such a great reminder to never count your chickens until the eggs are hatched. There have been so many deals I've been this fucking close to having closed, and something one way or another came up, and the deal ended up not getting across the finish line. So just be really, really careful about, I have like this superstition of I cannot count a deal as done. When people start congratulating me, I'm like, no, don't fucking say a word. Once that contract is signed, the deed is recorded, the funds are wired and closed, and we're good, then we can talk. But just know that you got to get it across the finish line. You know, you don't get a touchdown for getting to the 99-yard line. All right, this one is really, really important because I do believe this section is what separates the good investors from the elite investors. Don't get me wrong. If you want to align with a great operator, you want to place capital with them, that's why a lot of people invest with me in my deals, because I eat, sleep, and breathe and operate real estate. I've always been a hands-on operator. I've never used or leveraged other people to go and do what we do. And therefore, if you really want to be a successful real estate investor, you do have to treat it like a business, and you have to operate like a pro. And so many people think because they can punch a couple numbers into a spreadsheet and they can maybe engineer a little bit of a capital stack and, you know, do some of those simple things, that's just half the battle. That's really when, you know, the process starts. The real work begins when you close and you take ownership of an asset. And so having real systems, having a great team, having real checks and balances in what you do, how you oversee it, how you manage your assets, how you execute on every stage of the investment strategy from acquisition to stabilization, if you were going to hold it and just manage it long term, or you're going to obviously exit it, you have to be an elite operator and you have to have that mindset because that is the difference between a good and a great investor. 16 is improve what pays you back. So obviously there are certain things in particular asset classes, whether you're investing in residential real estate or you're investing in, you know, commercial real estate, where you're going to get a much higher ROI on where you're investing your time, your team, and your resources. So obviously when I was flipping houses, you know, I wasn't putting all the money into the paint color. I'm putting it into the kitchens and the bathrooms. I'm putting it into the infrastructure like the roof or the HVAC, because I know that those are going to be the things that obviously get me the ROI on my investment. In real estate, we want to focus on the things that really either one, drive income in commercial, and that's, you know, improving leases, that's bolting on ancillary revenue streams, or you're looking at expenses, right? If I need to restructure how the property is operating, if I need to renegotiate with vendors, if I need to go out and restructure my leases so the tenants are sharing in the expenses and the insurance, you really want to make sure that you are focusing on improving the things that really drive cash flow or value, whether it's in residential or commercial. Number 17, screen every tenant. This is something that is so important, right? Your tenant is your income stream. And especially in commercial, your tenant is your value. If your income is your tenant, then your tenant is really your value. And therefore, those are partners. Those are people that you want to see succeed. And the way that you can make sure that you protect your asset, whether it's, you know, renting out on a single family rental property or a multifamily unit, whatever it may be, just make sure you're doing deep reference checks. Make sure you're doing, you know, due diligence on their background, on their business plan, on their financials. Because if you get a great one, they can make your life fucking a breeze and be so valuable to you. And if you get a bad one, oh, ask me how I know. I've dealt with too many over the years, and guess what? It's because I skipped fucking steps like this or overlooked red flags when we came across these types of steps. Number 18, you guys tell me too, what is not on this list? Because I might want to improve this list. I had it to 25, but it's down to 20 now. But I'd love for, if there's some things that I know my seasoned real estate investors out there are listening to this, if there's some ones that are missing on this list, I want you to drop some dimes over to me here. So number 18, enforce the rent deadline. I can't tell you how many times, because I have a fucking heart, all right? I love people. I want people to win. I want businesses to win. but having a clear criteria of like, this is my line. And once that gets crossed, like, one of the best quotes that I heard at a business conference a handful of years ago is, I am a loving human being, but my standards are not. And I believe that you can still have empathy towards people. You can still give people grace. But if you have a standard, then you got to uphold the fucking standard. Or guess what? It's not a standard. And therefore, it's just an exception to the rule. And exceptions to the rules often come back to bite you in the ass, especially in real estate. So whether that's a rent deadline, whether that's a specific criteria that they need to meet in order to be in business with you or to go into your property, make sure you enforce those standards. Number 19, maintain it like you mean it. This is something I learned in the hotels, especially in properties that have many seasons. If you're in snow or ice or around water, your asset is your investment. And just because you bought it doesn't mean it's going to stay that way forever. And so having a really good maintenance plan, we've got great maintenance systems. The hotels really forced us to do that. Obviously, you got people coming and going out of your assets every single day. And you've got to maintain your properties so they remain functioning, or guess what? People ain't going to come and pay you money. So make sure that you have a good system and structure. We have a maintenance checklist that we use. I'd be happy to share that too. But that's something that I know is like making little tiny investments to ensure that the upfront deposits you're making to those types of properties along the way really do pay out longer term returns. And you just want to make sure that you're maintaining those things, quick little, get 3 bids, blah, 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 right? Last one is walk the unit before and after. So that's just a little something of making sure that, you are doing the necessary due diligence and checks before and after. That's another one of our kind of, checklist processes. So these are, none of these are laws that will make you rich this year, but you follow them for a decade. Completely different story. So what did you guys think of those? Which one was your favorite one? Which ones would you add? That's something that I would love to hear a little bit more of from your guys' perspective, because like you guys, I'm a student of life. I'm always looking for my next teacher. I'm always looking for the next little nugget, and that's something that I know has been really helpful to me over the years. Those 20 laws of real estate investing, I think, can make anybody successful and build real wealth, whether you're doing single family or commercial real estate. All right, let's roll into 5 non-negotiables when raising capital. I know a lot of people are raising money for their businesses, for their real estate deals. They are, focused on just bringing new people into your world. I mean, I think one of the best assets that people have that they undervalue or underrate is the relationships that you have around you and the money that you have around you. And obviously, you've got your, what I call your inner circle. That's your family. That's your friends. That's the people who already know, like, and trust you. Like, those are your peeps, right? You don't need to convince them who you are. They know who you are. But then you go a layer wider, and that is your social circle. That's people who like, oh yeah, Matt, I think he's a real estate investor. He's got a fund that people invest in, and he lends their money out, and he pays them 10%. I think I know a little bit about him and what he does. But they may like you, they may trust you, they may think you're an authority in your space, but not really, right? And so that's more of your social circle. But those are people that obviously you want to get in front of. And those are additional assets. And then I call it kind of the third layer, which is the people who don't know about you yet. A big part of why I do the podcast, a big part of, why I do the content that I do is I consistently want to, the content that I do, this show, connecting with you guys, this is a window into me. It's a window into my world. It's what I'm doing, what I'm passionate about. I've got my core pillars of I love real estate investing. That's kind of like my core tree trunk. And then I have my branches off of that tree, which are of course, my family. Y'all know I love being a dad. That is like the number one thing that lights me up in this world at this season of my life. Number two is I love my wife, and I love going on date nights with her and, building a strong and beautiful marriage. I love fitness. I love food. And I love, traveling and getting to connect and learn and grow along other people that share in those same kind of values. And so content is the window, it's the bridge into me. Yours is the same way. And I know some of the best people that I connect with on social media, we share those commonalities and those similarities. And oftentimes I am able to, through those pillars, find ways of being of value to them and going, hey, this is what I do, right? I don't just shove it down their throat, but I'm always looking for ways to create value, to create awareness, and to identify people that I can help, and therefore it helps grow my business. And so obviously you guys know that I have the experiential investment fund where I take people's capital, we pay them 10%, I lend their money out, they get a monthly check, and obviously we're lending, in, real assets that are backed by collateral. And number one, when you're raising money, is, and this ties into that long fucking monologue that I just did, sorry, is build the relationship before you need it. Or a good way of looking at it is, dig the well before you want to scoop the water. And I think oftentimes, and I've done this in the past, I'm like, oh, I got this fucking great idea, or I got this new deal. Where y'all at? Come on, like, get on the bus, let's roll. And what I realize is everybody's out on the fucking playground and I'm sitting in the parking lot and I'm like, oh shit, I got to run over there and I got to tell them and round them up. And so you want to make sure that you're building relationships, you're adding value, you're giving people a window into your world and sharing what you're doing way before you ever have the opportunity that you want to dangle out in front of them, right? Which is number two. Once you do, this is really important when you're raising money, is I have seen a lot of people get in trouble from this, so I just want to make sure you don't get in trouble. I wouldn't be able to talk about, the 10% that we pay in the fund if I didn't have a fund structure. So I have an SEC regulated 506C Reg D fund that allows me to talk to accredited investors about the fund and what we're doing. I see a lot of people throwing out numbers or potential guarantees. There's a lot of legal language that can get you in trouble, whether you're raising for your business, you're raising for a real estate deal, you're raising for something else. So know the exemptions, the laws, the rules and regulations that you have to play by, because the last thing I want to see is anybody just get in trouble. It's just not worth it. So be careful there. Number three, non-negotiable when raising capital, is lead with the downside. Most people are like, okay, the upside sounds great, and if it sounds too good to be true, fuck, man, I wish there's so many deals that, one, I'm glad I didn't invest in. I'm like, man, that just sounds too good to be true. And in hindsight, it was fucking too good to be true, and it ended up going belly up, or it didn't get anywhere close to those numbers. The most successful people that I see raising money are the ones who are the most conservative with their assumptions. They of course, talk about, if we do these things, we think that we're going to hit these returns. And yet we've stress tested this deal so many ways, and we've looked at this downside, and we've looked at what if this happens, and we looked at this trapdoor, and we looked at if, the rates go up here, and we looked at, we think we could get these rents or these numbers, but really we're going to just come 20% below that just to be safe, right? Like having the rosy colored lenses that I saw so many people, especially post-COVID, which, there was a lot of tailwinds going on then, and rents were going up and capital was cheap and prices kept going fucking through the roof. So I understand how people fell victim to that. At the same time, the number one thing when you're raising money and somebody gives you a couple commas and zeros worth of their hard-earned dollars, number one is protect capital at all costs. And the way you do that is by being conservative and just being honest with yourself of, if I'm conservative here, do these numbers still make sense on this deal? And if they do, great. And if you have some internal model that you think is going to fucking crush it, awesome. You're going to look like a rock star when you hit those numbers and they were expecting all the way down here. Because if they did the deal down here, how do you think they're going to feel when you're up there? They're going to be beyond ecstatic. And guess what? When you go and hit those returns and you close out that deal, or you are consistently giving them what you told you were going to give them, what are they going to do? You're making them money. You're doing it passively. They're going to go, Matt, when's your next deal, bro? Like, this is awesome. Like, great, right? And for me, going back to crock pot versus microwave, I'm playing this shit for when I'm 60, 70, 80 years down the road. I'm 38. I've been doing it for 16 years, which is a long time, but I still feel like I'm just hitting my stride. The last thing I want to do is overpromise and underdeliver. So non-negotiable when you're raising money, lead with the downside, not the upside. Be conservative. Don't be overly optimistic. And if you overperform and or if you underdeliver and overperform, you're going to be looking really good. Number 4 is, this is one of my honestly biggest failures in my career, just being totally transparent. I only raised money for one other person's deal in my entire career, and guess how it went? I wasn't in control. I didn't get the transparency and a lot of the things that I was hoping for. I wasn't, in the driver's seat. I raised money for somebody else's deal that I wasn't the core, driver and person on, and that bit me in the butt. It hurt some of my, investors, which thank God, for my entire career. It's happened one time. And they understood and everybody knew the risks going into it. But at the end of the day, a lot of people went into that deal because I was the one raising the money. And that's something that was a hard lesson learned. And I'll never, going forward, raise money for anybody else's deals but my own. And they will only be the deals that I'm in, that I have money in, that I'm controlling all the decisions of, that we are operating. And that was a hard lesson learned. And I've seen a lot of people make the same mistake where just because you can raise money, just because somebody will write you a check, doesn't mean you should. Doesn't mean you should take it. And again, if we're going crock pot over microwave, maybe you don't do a deal. Maybe you miss out on a sliver of equity. Maybe you miss out on an opportunity that really looks fun and cool and sexy. But relationship capital and reputation capital is something that I pride myself in working my fucking ass off to build for a really long time. And that was a hit. I'm like, hey, if I'm gonna die on my own sword and one of my own fuck ups, I can live with that. But allowing somebody else to cut your throat and you didn't have a choice in it, that hurts. So number 4, never sponsor a deal, never raise money for somebody else's deal if you're not in the driver's seat. That's just a rule and a non-negotiable for me now. Not everybody lives by that, not saying you have to, but it's something that I think is honestly a good one to abide by. And the last one, this is something that I know most LPs struggled with when deals started going sideways, when returns started not looking so, sexy anymore, is if you're going to take somebody's money, you better be accessible, you better be transparent, and you better be hyper communicative. At the end of the day, I have money with Ryan in the stock market, and guess what? He is always accessible, he's always communicating with me, and he's always transparent. And that is no different in any of my real estate deals. Investors, whether it's good, bad, ugly, whatever it may be, they just want to know that you're available, that you're talking to them, that you're not hiding, that you're not keeping things from them. And I think that's something that's really, really important if you're somebody that's going to be raising money in real estate. Make sure that you are reporting every quarter, depending on the project, right? Right now I've got my TJ Maxx and Harbor Freight stuff. So with my investors, I'm sending out monthly updates. So that way, they're in the loop because there's a lot going on, right? Once that's done and doors are open and everything's stabilized, they'll get a quarterly update on not much to report. Things are going good, hopefully, right? And that there's no major hiccups, but just make sure that you're reporting, you're over communicating, and you are being consistent with how you make yourself available to your investors. So those are the 5 non-negotiables for raising capital. Build a relationship before you need it. Know the laws and legalities of what you can and can't say when you're raising money. Lead with the downside, not the upside. Never sponsor a deal that you are not in or in control of. And report every quarter. Communicate frequently, and always be accessible. So what do you guys think of those? Those are good. Would you add anything to that list? I know many of you who have, are watching and listening to this right now. And big shout out to everybody that's on the feed. I don't know if I can or can't see all of the comments here, but this is I think, for me, it's the most that I've had on the live stream before. So big shout out to you guys. Thank you guys so much. We'll close it out on this one. I know we didn't get to a lot of stock market stuff today, and I'm not even going to act like I can speak to that shit. I give Ryan my money, and I love opening up my Charles Schwab account. In the last few days, obviously, the last few months, this year, the stock market has been nice and juicy. Are you guys stock market investors, or are you real estate investors? Which one are you first? I'm assuming both, but what's your core, investment focus? What do you like more? Being the way real estate has been this last, 2 years, and the challenges that have been in the industry as a whole, I have loved being diversified and seeing what my stock portfolio has done, because it's been not so hot to being a real estate investor the last couple years. So, all right. I know many of you have kids. I know many of you are thinking about raising kids. Anybody that is looking to build wealth is, wanting to build a better life for themselves and their family. At the end of the day, I've seen trust fund kids that have inherited a lot of money and been complete assholes with it, and it just makes them more of who they already are, and they suck, and they're just entitled, and they don't work hard. And I've seen the opposite of others who have taken that and built massive empires from it and scaled above and beyond. And this was a little X thread that, let me see if I can pop this up. Yeah, here we go. So this was an X thread that I saw today. And if you're not following Nick Huber on X, he puts out some pretty good stuff. I don't always agree with everything he says, but I mean, who the fuck agrees with everybody nowadays, right? And so he was talking about, having an 8-year-old, a 6-year-old, and a 4-year-old. My girls are almost 12, 9, and 2. So similar. He says, my family is financially well off, and we have a lot. What is your best advice on how to raise humble, hardworking kids? And, I think this is a real question that people struggle with. Brandon, thank you for saying what up. Yeah, let's connect. I think that, what it really comes down to is the core values. I go over my core values with my kids every day. I was at an Andy Frisella conference. This is when him and Ed Milet were doing, what was their mastermind? Arete Mastermind. And I went to one of their events, and dude, those guys are fucking killers. Like, they were just so good. And one of the things that Andy Frisella kept talking about was core values, core values, core values. And he was obviously talking about it from the perspective of his business. And from his business perspective, he would reward his kids or his employees, or reprimand his employees based on their alignment or misalignment with their core values. And I was like, man, and I think Ella was, 3 at the time. Evie was just born. So but I was like, you know what? This is going to be our operating system, our compass, our North Star for everything that we do. And my belief is, raising good humans is a very subjective term nowadays. Everybody's got their opinions on it and what's right and what's wrong and all these different parenting styles. And you know what? At the end of the day, my thing is, do you? I want my kids to be overall mentally healthy, physically healthy. I want them to be kind, respectful, courteous. I want them to have a good work ethic. And whatever it is that they decide to apply themselves to in life, I want them to leave it all out on the metaphorical floor of whatever it is that they're deciding to pursue. So we came up with these core values. I'll share what ours are. You guys tell me what your thoughts are on, what you think, and feel free to drop it in the chat right now. Aaron said, don't be their safety net. Let them fall. We've got a lot of helicopter parents that want to, bubble wrap their kids nowadays. I think the Gen Z generation is maybe a little softer than most. Not saying all are. I'm not throwing out blanket statements, but I think obviously, a lot of generations wanted to protect their kids because they had a hard upbringing, and we became the trophy generation. And I think this new generation of kids is starting to see a little bit more of a balance. Maybe the pendulum is swinging back. So our HSN family core values. You ready for this? All right, I'm going to read these off. And I read these to my kids. We talk about these every single day when I drop them off at school and when we pick them up. And I always ask them one question: which core value did you exemplify today? And it leads to some amazing conversations. And this is something that I know keeps us close to proximity around the things that I value and that we want our kids to value. And this is where, if you have your own, whatever you believe, whatever you want to instill in your children, I think it's staying intimate with those things, just like it is with your goals. If you set a goal and you don't look at it by the end of the year and you wonder why you didn't achieve it, it's because you didn't stay intimate with it. I always tell, people, it's like, you got to make love to your goals, man. You got to make love to, honestly, anything that you care about and get close to it every single day. And so for us, number one is growth. We embrace challenges, never give up, and keep improving. Number two is respect. This is a big one. And the best compliment I ever get is, your kids are so courteous and kind and respectful. Respect. We treat others with kindness, love, and dignity. Number three is integrity. We stand for what's right. We tell the truth and we lead by example. Number four is gratitude. We practice gratitude every day in the car. We are thankful for our blessings and choose a positive outlook in all situations. Number five is accountability. This is a funny one. I got a story on this. We own our actions and responsibilities without making excuses. And accountability is great because every time if I get a little sassy with Marie or whatever, the girls will hold me accountable and go, Dad, are you talking with kindness and respect to Mom right now? And I'm like, all right, fair enough. Let's go. Number six is love. We unconditionally support and love one another, and we always have each other's backs. And number seven is adventure. We lead with curiosity and bravery to maximize life's beautiful experiences. And so I guess my point around this whole topic, right, is how do you raise humble, hardworking kids? I think it first starts at the foundation of what is their operating system. You can get after it. You can, put them in hard situations. Our big thing too is if you make a commitment, you see it through. I don't care that you don't want to do that shit. You made the commitment, get after it. Let's go. So I think, but it all starts with the foundation and the operating system, and that's where I think the core values come in. I know that, there's a lot of great people out there who have had great parents and great operating systems, and I know that there's some that haven't and, are extremely successful and epic human beings too. So I don't know if I have the science or the answer to it, but I just found it to be an interesting topic. I mean, a lot of people, this was, interesting thread to read through was, do everything in your power to get them used to hard chores, real chores for long periods of time. I saw a lot of people talking about being responsible for animals. Animals popped up a couple times which again kind of comes back to responsibility. I think a big one is you modeling it for them. What does this look like? And just not handing everything over, but actually doing something together with them that is hard, I think doing things together is really important. What else? Yeah, so I mean, those were some interesting things. Let's use quick and rich to Okay, yeah, that's what the fuck was that? Anyways, so those are, some of the things that I thought were important to highlight today, because I don't know if you guys are seeing this, but there's like a resurgence of epic parents right now. Like, if you follow, Dadstagram or Momstagram, the amount of people that are prioritizing their kids, and not just like giving their kids everything, but are just like showing up for their kids, like are highly engaged. I mean, and these are people with big businesses, busy lives, average working Joes and gals and Janes that are fucking slaving away at their jobs, and they're still finding a way to get it done at home. They're not coming home and kicking their feet up and saying no and phoning, the face. And I'm proud to be a part of a generation and just a season of parents that are playing full out for their families right now. I love to see it. I'm a big believer in the nuclear family. If you choose not to have kids and you don't foresee that as a valuable point in your life, I'm, no judgment whatsoever. I got a lot of friends, millennial friends that, have chosen not to do that for a variety of reasons. But man, is being a parent one of the best fucking things on planet Earth. I don't know if there's anything that's been more challenging, more rewarding, forced me to grow in so many areas that I didn't even know I needed to go. Like, the kids have a key to my heart. We as human beings, I think one of the most epic human emotions is experiencing love. And I love my wife. Fucking love you, Marie. But there's like a special key that your kids get to your heart that you didn't even know was there. And when they unlock that, it's like a staircase that goes down into the depths of your soul, that the discovery process is just never ending. So proud to be a dad, proud to be a part of a generation of, moms and dads that really give a fuck and are showing up in a really big way. And I think one of the best things that we can do is give them the right skills to obviously succeed in life. A financial skill is something that's really important. The conversations that weren't had around the dinner table in previous generations, I love to see and hear and encourage more people to be having those. Be more transparent with your kids, share more, because I think those are things that the best legacy we can leave, the best generational wealth that you can give, is not how many commas and zeros are sitting in your trust account that you pass through your estate. It's going to be those little fucking humans that are running around and are carrying on your legacy. Nobody's going to know who the fuck I am in 2 or 3 generations, but there will be little pieces of me in each of those kin that, my kids and their kids and their kids' kids pass along. And I think that's probably one of the coolest things that, we can leave on this earth, and the best wealth that we could build. I'm going to wrap it up on that. Next week, we've got, we went a little long today. Sorry, I had a little fun with you guys. That was great. Hopefully you guys enjoyed this. Let me know your thoughts. And I am going to break down in next week's episode, or really this Friday's episode. If you guys like the live streaming, I'm going to do more of the live streaming because I enjoyed the comments. Brandon, thank you so much for saying what up. Sergeant Palon, Mr. Aaron West, one of my favorite humans on planet Earth. Love connecting with so many of you. Mr. Michael P. Delaney, great to hear from you, brother. I'm thinking I'm going to do more of these on the live stream format. On Friday, I'll have a fund update for you guys. That's something that I've been talking about, building the fund in public. We've got some cool little giveaways that we're actually going to do through the Imagos X brand and some of our concierge services that that company is providing to people. When we secure these massive packages, $200,000, $300,000, $400,000, $500,000 packages for some of the celebrities and clients that we have that are spending a lot of money, the promoters or the people that give access to these packages, they give us a bunch of other freebies and stuff. So I'm like, man, we should just throw these out to you guys that are listening. These are like still really cool tickets, access, backstage, all kinds of cool stuff. So I think I'm going to start throwing those into the mix. And we're going to dive into some of the top things that we're using AI agents for in the business. Major, like honestly, efficiencies, cost savings. You guys heard me say this. It's going to be the, gradually then suddenly. Like I think, in a couple years, people are going to be like, oh, AI agents. Yeah, I get it. I still think a lot of people don't fully understand the power of them, how easy they are to build and implement in your business. There's a lot of great tools. AI is, of course, a powerful resource that we can use in the right ways, in the right areas of your business. And so I'm going to show some of the stuff that we're building, what we're doing. But as always, thank you guys so much for tuning in. Appreciate each and every one of you. If we're not connected on social media, I know there's a lot of people that are listening on different platforms here. So if you're not following, give me a follow. If you guys don't mind, I don't ask this very much, but one of the things that we're really pushing right now is if you enjoy any of the content that we put out and you're listening to this podcast, would love for you, whether it's Spotify or Apple Podcasts, just leave a review. An honest review, right? I'm a big boy. I can take the criticism if there's any criticism, but please leave a review. That means a lot to us. And be sure to shoot me a DM. Say what up. I really, the one thing, talking about the window, it's one thing to look. It's another thing to, cross the bridge and engage. And that's honestly the main reason why I do social media is I don't want to just, talk at people. I want to talk with people. I want to build relationships. I want to do life with fucking epic human beings. And that's one of the reasons why we're rebuilding and revamping the Millionaire Mindcast and my personal brand. So as always, keep investing in yourself and your wealth on your march to a million and beyond. I'll see you guys in the next episode. Cheers.